All right, hello and good afternoon, investors and traders, and welcome back to another weekly State of the Market with me, Seth Golden. And we've had a lot of price action over the last 2 weeks. Just 2 weeks ago, we found the market down about 3.3% on the S&P 500, and then wouldn't you know it, the very next week, the S&P 500 was up 5 days in a row to total about a 4.6% bounce back in that week. All the major averages soaring, especially the small caps. And that sets up the stage here this week where, on Monday we had a positive day. Tuesday and Wednesday, a lot of choppy price action. I think the S&P 500 from Tuesday to Wednesday lost about 5 points. Here we are on Thursday. Jobless claims were released. A little worse than expected, but the market's continuing with this choppy price action. Small caps are starting to fade a little bit. Extremely overbought conditions, which we'll get into in a moment. But the trend is still your friend. The market is still in an uptrend. Don't dismiss that, folks. The dips have continued to provide you with really strong buying opportunities. And we've been in this buy the dip trend for quite some time now. So with that being said, let's get right to it. All right, market trend. I was thinking about this the other day. I do a lot of gardening around my house. I like it. On Sunday after church, I like to, if it's the fall season, early winter, I'm raking leaves, replanting resoiling planting beds. I have some rose bushes. I have a lot of azaleas. Well, and I was thinking about the thorns in the rose bush and the whole market, paradigm. And this is basically what I come up with. It's actually inspired by another gentleman that I read on a weekly basis, another investor. So investors must be able to recognize the long-term uptrend. A trend can be quite beautiful, much like a rose. Many avoid holding a rose so as they don't get pricked by the thorns. And just like every rose has its thorn, famous Poison song from the 1980s, every uptrend has its prickly points. Savvy investors know that these prickly points in the trend are not any more poisonous than a thorny rose. These are opportunities. In order to comfortably participate in an uptrend, we must be willing to accept the prickly spots, the same as if we are to behold the beauty of a rose. Something from Jack Bogle. Learn every day, but especially from the experiences of others. It's cheaper. And let's face it, if you're a new investor, even an intermediate investor, and you're trying something new or you want to try something new, learn from others. Learn from their mistakes. It's a lot cheaper to learn from somebody else's mistakes than to go out on the risk curve and suffer greater losses when, well, there's an alternative. Learn from the experience of others. Markets do not travel in a straight line. I'm sure we all know that. The oscillations, the dips, the volatility along the way are the price the investors basically pay to ride out a long-term uptrend. And folks, we are, in an uptrend. It started basically last year at the March bottom. We've been using the 2009 into 2010 analog to, see what we're replicating from that from 2020 into 2021. Now, as we've talked about it in the past, we were supposed to get a dip there around January 20th. January 20th, we were supposed to start this 2 segments of a dip that would culminate with an 8.2% correction, as it did in January into February of 2010. Now, we had about a 4.5% consolidation from the all-time high and going back 2 weeks, but then we quickly got it all back and made new all-time highs. But do keep in mind, this particular zone right here from 2010 was actually 2 waves. There's 2 waves here. The initial wave And then the second wave that would take you all the way down, an 8.2% correction. And, you know, when we look at the past from the 2020 versus 2009 analog, it wasn't perfect. It deviated right here, and it deviated right here. So we may have not gotten the full extent of the analog here, but it's still following the same path. So be open-minded, be flexible to any possible outcomes going forward. To hold a rose, you have to put up with the thorns, folks. And we may get pullbacks. Could be a bumpy ride here as we progress through 2021. The S&P 500 50-day moving average spread. Now you can recall, one of the hallmarks of a bull market is that corrections are swift and shallow. Swift and shallow. And windows of opportunity for investors on the sidelines is usually narrow. When you see these dips, folks, they should be a trigger for you to start, you know, layering into positions. On January 20th, the S&P 500 closed at extreme overbought levels, which we classify as more than 2 standard deviations above its 50-day moving average. 7 trading days later, folks, on 129, the S&P 500 was down 3.7% after being overbought. Faster than the S&P 500 sold off, though, from extreme overbought levels to below its 50-day moving average. And you remember, 2 weeks ago, we closed at 37.14. The 50-day moving average was at 37.15, I think, or 37.16. So faster than we sold off and fell to our 50-day moving average, the equity market bounced back. And we're right back where we were at extreme overbought conditions, hitting new highs once again. But the point here is that pullbacks are genuinely swift in an uptrend and quite shallow. We don't know if we're going to get a 10% correction or not. But you should have a plan for either a 4%, an 8%, a 10% correction in the market, either way. All right, this chart right here, we look at breadth all the time. You know, we want to know what is beneath the surface of the market that lends itself to buying the dip. One of the things that lends itself is knowing that the percentage of industry groups within the S&P 500 is also trading nicely above the 50-day moving average. Many industry groups are trading above, 97% of industry groups right now are trading above their 50-day moving average. 99% of industry groups are trading above their 200-day moving average. That's strong breadth. That's broad participation in the market. That is a signal that there's a lot of money coming into equities for each and every time the market does give that opportunity on a pullback. All right, this is your S&P 500 chart. You can see the channel that we've been in since about October here as we are traveling the upper Bollinger Band. We're traveling along the upper Bollinger Band. And we're spending a lot more time with respect to the trend channel. We're spending a lot more time at the upper end of the trend channel than we are at the bottom. The bigger the pullback, naturally, we find our trend line support. But for each time that we finished here above the upper Bollinger Band, here above the upper Bollinger Band, we've found some consolidation. We've found some consolidation here. We found some consolidation. When we finish below the lower Bollinger Band, that's also a signal. That's also a, you know, the extent of the consolidation is probably over and you need to be buying that dip. And here we are. We're still within the Bollinger Bands here, but we have been just testing, really tempting people, you know, to start consolidating their profits. Right now, the S&P 500 is also, this red line here, is the 200-day moving average. At present, 13% above the 200-day moving average. We've been upwards of 15% above the 200-day moving average. So in terms of what happened in January, it allowed us to work off some of the extreme overbought conditions with respect to where the S&P 500 prices versus its 200-day moving average. 13% is still an overbought area, but not as overbought as it was only a few weeks ago. What happened in January? Nothing. We consolidated in terms of time. Remember that the S&P 500 indexes can consolidate for both price and or time. Seeing how we bounced back so quickly to start February, all we really did was lose a little bit of time, but it allowed for the 200-day moving average to actually curl up that much more and reduce some of those overbought conditions. Some of them, not all of them, obviously. Now at the bottom here, you see the 14-day RSI. And throughout the entirety of this process, from October to present, we have failed to achieve a 70 RSI. You've heard overbought, you've heard overextended. But with respect to momentum, we've not found overheated conditions through the metric of the 14-day RSI. Typically overheated correlates to a 70 or better RSI, and we just haven't been able to achieve that. It's quite unique, actually. You look at the Russell 14-day RSI, it's been over 80 more recently before yesterday's pullback. The Russell actually lost 0.75%. It led the way down in the market on Wednesday. So the uptrend is strong and supported by robust breadth and industry groups. This chart right here, we've talked about recently. This is the percentage of stocks trading above the 10-day moving average. And you can recall 2 weeks ago, this was basically our buy signal. This was, somewhat of a call to action, because in the past, when it had gotten down to these levels, the market has bounced. The market has bounced. Gets down here again, market has bounced. When breadth signals show oversold conditions, as they did 2 weeks ago, you should take them as a call to action when we are in an overall uptrend. And as you can see now, it's bounced all the way back. The percent of stocks trading above their 10-day moving average above 82% coming into Thursday's trading session. So for everybody that's, we need a correction, we need a bigger correction, the reality is those ducks are always quacking for a correction. It's not for us to reiterate that we just had a correction, but to recognize that the impulse is still there for a correction to be achieved by this cohort of market participants. They're always going to be calling for a correction. What they're failing to do is take advantage of these shallow and brief dips in the market. We've had many corrections, since October. All right, in keeping with the theme of, this global uptrend, it's not just the United States, folks. It's the whole world market index, as you can see here. Percentage of world markets above their 50-day moving average, also above 80%, above their 200-day moving average in the lower panel, above 90%. So it's not just the US. This is a global equity market uptrend. All right, hearkening back to last week as we, kicked off this week's state of the market, I had mentioned that, every day last week, the S&P 500 was up 5 days, coming in, 6 days in a row, counting this Monday. But if we just look at last week, up 5 days in a row, here's some historic data to consider. The S&P 500 performance after a perfect week, meaning all days are up. This data goes back to 1990 from LPL Financial. It's happened 19 times, and 1 week later, so-so. And really, you got a 50-50 shot. Returns aren't anything to write home about. 2 weeks later, a little bit better, and the positivity rate also a little bit better. 1 month later, again, a little bit better, but the percent positive rate is that much better. The returns start getting really good 3 months out, 6 months out, 12 months out. Again, when we look at the historic data, it's not a guarantee, but it sets you up with the probabilities going forward. Know your probabilities going forward. You want to stack the deck in your favor, and this is one way to do so with the historic data based on what just happened in the market. Breadth and momentum, they're often linked. A consistently high percent of S&P 500 stocks remain above their 200-day moving average. In fact, if you count this week, the number of days with greater than 80% of stocks above their 200-day moving average, this study, I think, recognizes 61 days, 61 consecutive days, that more than 80% of stocks are above their 200-day moving average. So using that criteria, again, 1, 2, 3, 4, 5, 6, 7, 8 samples. So this has happened 8 times in the past. The forward-looking returns, it should probably jump out at you that there's a lot of green on the screen, and the percent positive rate, the positivity rate, a lot of hundreds and 80s. We'll take 80s. That's good too. But 1 month later, the average return 2%. 2 months, 3 months, it just keeps getting better. Looks like in 2011, that was and of course, that was the European debt crisis. So it's also important to recognize, when you see these jump out at you, these glaring outliers, if you will, harken back and remember the time. Well, what did happen back then? Is there a probability that happens again here in 2021? And let's not, just say, well, it's got to be a European issue. Look, anything can, when the market is in a really strong uptrend and persistent for a good amount of time, price gets very sensitive the higher it goes. Doesn't have to be anything, overtly dangerous that the market reacts to. It could be a headline. It could, and the media will try to correlate price action with some type of headline, some type of macro issue or geopolitical issue. But the reality is, people are looking for an excuse to lock in gains. A long-term uptrend, people are looking for any excuses to lock in gains, deleverage a little bit, and reposition in the future. All right, looking at, all the different trends here in terms of our sector performance, that's what you see here, all the different sector ETFs. And something else should probably stick out like a sore thumb when you look at it. All of the sector ETFs are above their 50-day moving average, except for one. This little piggy does not belong here. This is the consumer staples sector ETF. And you can see, it's in the, technically speaking, it's still in the oversold area, but it's rather neutral at this point. And it's the only sector ETF in the S&P 500 that is trading below its 50-day moving average. You can see it here. It's also the only sector ETF in 2021 that is trading lower. I think it's down a little more than 2% year to date. Yep, 2.1% year to date. Here's the top holdings in the consumer staples sector ETF: Procter & Gamble, Wal-Mart, Pepsi. And you've seen the performance of these stocks over the last month or two. It's been abysmal. Procter & Gamble, great results. Beat on the top line, beat on the bottom line, didn't matter. Stock still traded lower. Pepsi today is getting taken out to the woodshed. Pepsi has gone from $148 a share down to $134 a share in about 30 days on nothing. When the company reported today, they beat on the bottom line, they beat on the top line. Coca-Cola reported the previous day, had a slight miss on the top line, but beat on the bottom line. Nothing wrong with guidance. Stock was basically flat, and today it's nicely higher. Yet Pepsi, with that much better results and organic growth of more than 5% in revenues year over year, 5.7%, it's getting taken out to the woodshed. To me, that's long-term opportunity, keeping in mind that the company raised its dividend also, raised it by about 3-4%. You get like $1 a share per quarter. You're not going to go wrong with Pepsi long-term. It's just a matter of this particular sector is out of favor. You know, Pepsi's not sexy. Coca-Cola's not sexy. Procter and Gamble is not sexy. But when you see these individual names performing as they have done over the last month or so, you recognize this is a sector issue. It's an investor appetite issue. Investor appetite has a way of mean reverting, normalizing, if you will. So just as easily as this sector has been found out of favor for the last month or so, it'll more than likely find that normalization of investor appetite in the future. All right, and I touched off at the top of this weekly state of the market talking about the Russell 2000. And as you can see here, folks, this is liftoff here. And what we have in the bottom panel, and this is from Strategas, the percent price is above or below the 200-day moving average. Clearly, it is above the 200-day moving average. This is your red line here. 41% above the 200-day moving average. Folks, that's never happened before. That has never happened for the Russell 2000. Just like sectors, there's probably going to be some normalization or some type of corrective action in the not too distant future with respect to the Russell, if not for anything else but investors locking in profits. Now, I think it's, if you get some kind of correction, I think you buy it. Easiest way to do it, diversification, buy the Russell, the small cap ETF, the IWM. Here's a chart, longer term chart from 2012 to present. And as you can see, it's been in a long-term uptrend. Don't get me wrong. You've had to suffer some pain over the years, especially the last 3 years, as you can see. Each time it's tried to bump above the Fibonacci 261 level here, and it got pushed back, and it finally broke through. The more times that you bump up against a key resistance area, just like here, from 2014 to 2016, you eventually break through. Bumped here, got pushed back, tried again, COVID-19. And here it is, a third time, and broke through. So while this looks like a rocket ship here, do keep in mind, if you just kind of wall this off or quadrant this off, this is a 3-year time frame of price consolidation. This is due for a pretty material breakout. People talk about, well, we're due for a correction. We're due for a correction. We need a more significant correction. They happen too quickly. We've had corrections, folks. This is just getting started. This is probably just getting started. And that's not to say the next Fibonacci level up here will be achieved immediately. I'm not saying that at all. Could have some consolidation, a retest of this Fibonacci level. That's what happened here. You had a false breakout here, and it came back and retest. It was a failed retest, came back down in into 2016, but then through 2016, it finally had a real breakout. So we could see the same thing here. You never know. You can see a retest of this Fibonacci level, and we'll find out if it's successful or not. And then another leg higher over the coming months and years. I would be of the opinion that you buy a dip. If you get down here, if not lower, I think if in a long-term portfolio, you buy the IWM ETF. And I'll tell you why. We can look at charts till we're blue in the face. We can look at breadth studies till we're blue in the face. We can look at our Fibonacci's, our resistance, our support levels till we're blue in the face. But you want to layer on fundamentals that give you that extra layer of confidence to understand whether or not you should take action on pullbacks. Why I say you should be a buyer of the pullback is when I look at US small caps earnings revisions, they are outpacing the S&P 500 earnings revisions and the Nasdaq's earnings revisions. So the fundamentals are supporting the buy the dip, if that should come to pass. If that should come to pass. The fundamentals say, yes, the earnings will be there to provide that fundamental support for taking action. All right, this chart right here, moving from the S&P 500 to the Russell, and now with the Nasdaq. And we got a bit of a breadth divergence here. In fact, it's persisted now for about 2 weeks. The percent of Nasdaq 100 stocks above their 50-day moving average, it has had a nice bounce here, but we still have this divergence. Price keeps going higher. However, breadth has not gotten back to the levels that it was when price was moving higher back here in January. Breadth divergences happen all the time, folks. They're normal. When I look at breadth, I look at the absolute level. Is the absolute level healthy? 73% of stocks are trading above the Nasdaq 100's 50-day moving average. Yes, that is a healthy level. So we can take it a step further. I mean, because there's something going on, right? There's a number of stocks that just aren't getting back up here. So we'll look at the advanced decline line in the Nasdaq 100, and we can see that's making new highs. So, when you have multiple, you can look at multiple breadth studies, advanced decline line, percent of stocks trading above a key moving average. Collectively, they validate price. They're validating the Nasdaq 100 price action. Now, here's something else from Chris Kimball recently. You look at this chart. This chart is the Nasdaq 100 to Nasdaq Composite monthly ratio. And as he outlines, the Nasdaq Composite and Nasdaq 100 recorded intraday all-time highs recently. The Nasdaq 100 index has outperformed the broader Nasdaq Composite. The ratio has been in an uptrend marked by, number one here, this uptrend, for 15 years now. But the ratio has reversed lower. So the Nasdaq has not been outperforming, the Nasdaq 100 has not been outperforming the Nasdaq Composite basically for about a month now. This ratio is testing this trend line. What happens when it breaks? Well, we don't have the answer for that. Remember, trend lines, support levels, they're not concrete. They're not made out of concrete. More often than not, you do break below it, and then you kind of slingshot above. So we'll keep an eye on this one, see what happens. What leads me to believe that nothing nefarious or exogenous is going to take place if it does break is that we still have very, very solid breadth in the market. This study right here is the Nasdaq Composite, not the Nasdaq 100. The study above is from bullmarkets.co. It recognizes a strong long-term breadth in the Nasdaq. Nasdaq up issues ratio exceeded 74%, meaning the number of stocks in the Nasdaq is increasingly higher, 74% of the Nasdaq for 2 days in a row last week and during the 5-day market rally. Historically, this almost always led to more gains for stocks over the next 3 to 12 months. Nasdaq was up an average of 5.5% 3 months later, 12% 6 months later, 15%, 19% over the next year. And again, this just happened. We like studies about what just happened. All right, well, this is February. We look at seasonality. Seasonality does play its role in the market because it lends itself to, outlining or extrapolating investor behaviors, right? This is for February. Now, if we go all the way back to 1980, February is actually a green month. All the way back to 1980. However, if you only go back to 2001, if you go back to 2001 to present, it's not so good. It's a down month. In the chart above, if you just go to 2001, February is a down month. What about election years? Well, doesn't get any better for February. As you can see here, after an election year, February is actually, well, one of the worst months next to August. However, look at January. January after election year is supposed to be up. We were down in January this year. Maybe they're going to have a reversal. Maybe January was down and maybe February will be up. You never know. That's why I say the historic data, it's not a guarantee, but the probabilities are very strong more often than not. And that's all we have here this week, folks. So, a lot to ponder, a lot to think about. We have investors getting back in. 2 weeks ago, everybody was deleveraging from the market. Remember, we saw just the largest degrossing, in the market since February of 2009, just 2 weeks ago. And then, of course, we rallied 4.6% in the S&P 500 the following week. So what happens to leverage? Well, look at the 9, folks. The 9 jumped up to 110, the latest reading. Dropped all the way down to 79 from 112 just a few weeks back, 83, then 79, now back up above 110 here. Because they're buying the dip. All right, folks. Well, that is our weekly state of the market. Tune in next time at phenomgroup.com.